All right, welcome to the Anton Stettner podcast. Today we're going to be talking about what are home prices and rates going to be in 2025. We've got the Nostradamus of real estate here, Anton. So this is a question I think everyone would love to know because then it helps you make smart moves or maybe when to make those moves. So what's your predictions for where home prices and rates will be for next year?
So, this episode is going to break into essentially three parts. Where are we at? What's going on? What are the predictions from the experts? We give our prediction, where things are going. And like you were just saying, I think, why do people want to know what's happening with home prices? It's so a home seller can make the best educated decision. So a home buyer can make the best educated decision on when to buy. So the investor can make the best decision on what's going to get them the most cash flow or when to purchase. And all that comes out of just having really good data. So we like to look at the national numbers, but one thing for you to take into ultimate consideration is we're talking nationally. You're gonna have to dig into this on a local level to get the exact numbers in your market. We can provide them here in the Seattle Metro for what's going on so you can be the most informed. So let's talk about, where we're at. So according to NAR, existing home sales, 3.86 million is the run rate for last month. Inventory's up just slightly, but with home sales at that run rate, that's the lowest run rate since 1995. I graduated high school in 96, so this is a long time ago. That's lower than the great financial crisis in 2008 and 2009.
Can you explain the run rate for people that
The
don't
run
know
rate
that?
is 3.86 million units. And when I say run rate, the sales were slower last month. So that's the current rate. Total, you're going to probably be at about 4.2. But if it continued at 3.86, it would be the slowest year since 1995. I mean, that's a long time ago. Second, affordability kind of sucks right now. Now, affordability sucks because homes are really expensive and rates are high. This is the second most unaffordable time in the last 40 years. So to put it into perspective, basically rates in the late 70s were in the 8 to 9%. Then we got Paul Volcker. Rates went to 8 to literally 19%. And in 1981, so what is that? 43 years ago, it was more unaffordable than today because interest rates were so high. Okay, what's happening with home prices right now? According to the Federal Reserve's website, Q2 2024, the Fed median sales price is $412,300 here in the U.S. Most of the data is showing that we're going to finish the year, even though it's coming down slightly. There's always a seasonality towards the end of the year. So the thing to be thinking about as a buyer or seller is the winter's cold. The spring, the market heats up, you get the most appreciation, and then most of that appreciation happens by June, and then by the start of fall, home prices actually start to fall just slightly. I'm talking like 0.5%. This year, they're probably going to fall a little more than normal just because of the fear, uncertainty, and doubt. Right now, it looks like we'll finish up, even with high interest rates, even with the fear, uncertainty, and doubt, 4.3% higher than the previous year. So what I want you to put into your brain, if things do exactly what they did this year, in 2025, the average home will cost $17,289.90 more, or almost $18,000 more, if it appreciates the same amount. So when you say as a buyer, I want to wait, or I'm thinking about waiting, do you want to spend basically 20 grand more by the end of spring? That's what the numbers are saying. We're going to get into the exact predictions. Now, what other factors are coming into play though? The economy is slowing down. Why is the economy slowing down? We've got rising consumer debt, decreased consumer spending, slowing job growth, rising unemployment, decline in manufacturing, and weaker business investments. So because the economy is slowing, well, what's the Fed done? What's our main man, Papa Powell, done for us?
Drop it like it's hot.
Yeah, he dropped it like it's hot. He cut 50 basis points. I went back and I did the research so that our listeners, our subscribers, because we always want to give you the best data possible, allow you to make the decisions about your financial future. What do you think when the Fed starts cutting? What do you think their cut cycle looks like? Like, how long do you think they cut over?
Well, I think, I don't know. I'm just going to guess like 1 to 3 years.
Bingo. The average cycle lasts 1.5 years of them cutting and lowering rates. So once they start, let's just say it's 1.5 years. So we know they started in September. So you just go 1.5 years out for them to finish their cutting cycle to hit their long-term target rate. So that means over the next 1.5 years, the Fed will probably cut 2.5% to get to R-star, or the neutral rate, over that time period. Well, what's that going to mean? Consumer debt will get cheaper. Housing debt will get cheaper. Businesses will be able to buy more. So the question I want you to be thinking about in regards to this is, does that mean home prices will go up during this timeline? Yes or yes?
Yes.
Yes.
That was an easy question, by the way, to answer.
So where have rates been this year? Rates have been as low as 6.1, and we've been as high as 7.3. Today, we're at 6.65. Okay, so we got really low right before the Fed cut. Fed cut happened, boom, it popped up. Now let's look at predictions. So where are home prices and rates going to go in 2025? And first, we're going to talk about home prices. The highest forecast was Goldman Sachs with a 4.5% increase, a 4.4% increase. Moody's was the lowest with 0.3. So we've got a range of 4.4 to 0.3 with an average of about 2.5. But when you look at this, I want you to ask yourself a simple question, and we'll go through each one of these here in just a second. If we know the Fed already cut rates and they're starting their rate cut cycle, and we know we appreciated 4.3%, and the average of all these forecasts is only 2.5, do we feel like they're possibly sandbagging this a little bit?
Explain that. What do you mean? The
Well,
Fed?
No.
The banks.
Wells Fargo, Mortgage Bankers Association, Morgan Stanley, Fannie Mae, Freddie Mac. If in 2023, with interest rates that hit a high of 2024 hit a high of 7.1, and the market still appreciated 4.3%, and we know debt's going to be cheaper next year, why is the average only 2.5?
I don't know.
What I'm telling you is it feels like most of these people, except for Wells Fargo and Goldman Sachs, are sandbagging a little bit. Because, see, people would rather underestimate on their home price predictions than overestimate and be wrong. And we do the same thing too. So when someone says, hey, what is it going to be? We kind of underestimate. But if homes appreciate in 2025, just what they did in 2024, we're going to beat all these. So Goldman Sachs, 4.4, Wells Fargo, 4.3, the MBA, the Mortgage Bankers Association, 3.3, Morgan Stanley, 3, Zelman & Associates, 2.3, Fannie Mae, the government, 1.5, Freddie Mac, the government, 0.5%, Moody's, 0.3, Zillow, 0.9. Sorry, I missed them in there. What are your thoughts when you look at this?
Well, I mean, I think there's two parts to it, and I'm not sure if we're going to go into it. And it's rates and how low they'll go.
Bingo.
And then as rates are going down, how high will home prices go up as more buyers come into the market and inventory stays low. So my prediction would be this. I'm just like pulling this out, by the way. We're going to probably go down 1 to 1.5% on the 30-year mortgage. So right now you said like about 6.5, right?
Yeah, 6.65.
Okay, let's just say 6.5. I think we could go to 5%.
Yeah.
But this is a tricky thing. If we go down just that, and it could be even more than that, because you said it's going to be over the course of 1.5 years. We just started it. So we got easily 12 more months. Then home prices have to go up as there's more competition.
Bingo.
And the real question as both a investor, buyer, and potentially seller is, what's that sweet spot? So my prediction, the home prices, we continue to see prices of homes slightly go down or just stay even for about 3 months.
Yep.
But then it's going to go up from spring all the way to next winter more than this year because we went up 4% in a high interest rate environment.
Bingo.
So like it all makes logical sense. And then there is a curveball that I'll talk about at the end because I want to test you or trick you.
So before we answer all those questions, let's go through like a high and a low. I think on the low end of the range, the U.S. housing market could appreciate 2%. On the high end of the range, it could hit 6.5%, which would be slightly above average. How would it hit 6.5%? If rates got into the mid fives and we unlocked that locked in seller and brought more inventory, that velocity of transactions, those move up buyers coming into the market could force that higher level of appreciation. So you nailed it, brother, when you said it will be rate dependent. Now, if we get the low side of it, why would we get the low side of that price appreciation, like 2%? Notice how none of these numbers are negative. The 2% will happen if inflation rears its ugly head again. If the Federal Reserve cannot keep cutting rates quickly, if the economy gets worse than they're predicting. In other words, we don't have a soft landing, we start to have a hard landing. Like if unemployment starts to spike and layoffs start to happen and consumer debt starts shooting up even more than it is from this all-time high that it's at right now, then expect lower numbers. So what's funny about these predictions, we almost have to use Papa Powell's line. Based on the totality of the data, we'll be able to move in a certain direction. Today, I'm personally going for, we'll just stick it at 5 nationally. I think it's going to beat 2024. But I think there's a high and a low. Let's go look at rates. And if we look at rates, we can kind of see what people are talking about. So on previous episodes and other things, we've talked about this idea of the spread. The spread is the difference between the 10-year treasury and then what a bank loans the money out. And they take that spread as margin. Historically speaking, it's been 180 basis points or 1.8%. It got as high as over 300 basis points or 3% because they knew all these loans were going to get refinanced, so they just needed more money. So I went and figured out people's predictions for the spread. Because even if Papa Powell doesn't drop the rates, but that spread collapses, because right now it's sitting at about 2.6.
And the spread being the difference between what the Federal Reserve's interest rate is and what the 30-year mortgage
between the
is set.
10-year.
Oh, the 10-year?
Yep, between the 10-year and 30-year debt.
Got it, yeah.
And that's the margin a bank makes when
Yes.
they loan that money out. So Fannie Mae predicts by the end of 2025, the spread will basically be right back in line. They say Q4 2025, 180 basis points or 1.8%. Mortgage Bankers Association predicts by the end of 2025, 200, which, that's over 0.5% right there. Okay. Wells Fargo expects us to be at 2.15 or 215 basis points by the end of the year. So if you look at all three of these and just squish them together and take an average, these three financial institutions are predicting we get over 0.5 point in interest rates. They'll just come out of the spread as the margin drops out. So whether or not the Fed cuts, there's probably 0.5 point lower rates coming just due to the squishing of margins. Okay, so that's item one. Now let's look at the forecast. So most of the forecasts are, after I did all this research, I want to take a step back. I go to Jennifer. Jennifer is our real estate team sales manager extraordinaire. She runs the machine. She makes sure our agents have what they need, all the buyers and sellers are getting what they need, and helps us to close the hundreds of transactions every year. She mans that business and runs that machine. And I go to Jennifer and I said, hey, I'm going to pop your bubble. And matter of fact, on the podcast and on good old YouTube, I think I'm going to pop everyone's bubble. Because I think the consumer and the real estate agent and the real estate investor and the mortgage broker believes things are going to drop faster than they are. And I think it's a little bit of that hopium getting back into our system. I think the Fed's got to beat us up a little longer to make sure the inflation's gone. And I think it's going to take longer because of it generally takes 1.5 years for them to cut the rates all the way. So a lot of people believe your prediction where we could be in the mid fives, low fives, maybe high fours. And I've been kind of hearing this, and I was starting to believe it too. And I'm a very optimistic individual. So I believe in the future. I'm excited about the future. And I look at this and I look at all the data and I go, bugger. I don't think we're going to get into the low fives. I think based on the data, we're going to be in like rock bottom sixes to upper fives at the end of 2025, unless major economic problems exist. Because see, if the Fed can maintain their slow landing, they can sit there and just cut really slow and just slowly let the air out of the balloon and bring us in for that soft landing. There's no reason for them to cut because the economy is still doing okay. But what happens is I want to buy more real estate. You want to buy more real estate. Our subscribers, you want to buy more real estate. So we want them to cut faster than what the data is showing us right now. Once again, check in with us as we go because this could change. But I don't see upper fours and low fives today. And nobody predicts that. So Fannie Mae predicts that we'll start the year 2025, 6.2, Q1, Q2, 6.1, Q3, 6, Q4 of 2025, 5.9. Mortgage Bankers Association, they say we're starting the year higher, 6.4, Q2, 6.3, Q3, 6.1, end the year at the same number, 5.9. Wells Fargo started at 6.15 in Q1, 5.95, 5.8, 5.65, and then down to 5.5. So Wells Fargo is coming in with the lowest amount here. Morgan Stanley's average prediction for 2025, 6.25. Wells Fargo's average prediction, low 6. I started Googling, trying to find other people's average predictions. These are the only ones I could find. Okay. Anton's average prediction prior to this episode was 5.5. Doing the research based on the totality of the data today, I think we'll be lucky to get 5.75 next year, and it's going to be in that 5.75 to 5.875 range by the end of next year. Now, really bad economic news, boom, that number goes lower. I don't see us getting into the fours, though, next year. I think that's hopium. Now, of course, if the economy continues to deflate and inflation and unemployment and all the bad things rear its head, we could get there. But it's not there today, so it's not going to drop as fast as we want.
Okay. Bring it back to home prices and let's do the math on it. Okay.
Yeah.
You said the year we're going to end around $410,000 for the average home price.
Yep.
Okay.
Yep. 413.
Okay. So, and you said that it's going to be in, you're going to need to pull out the calculator. And you said it's going to be about a 4 to 5% appreciation.
Yes.
Like this year. Okay.
Yes.
With the rates that you just discussed. Can you calculate what that would be
Yeah,
by the
so
end
you
of next
go.
year?
So for those of you that are listening and you want to become a real estate guru, you have to get good at your calculator. So take 413,000 times 0.05. So if the market appreciated 5% on 413,000, that means the median price home in the United States would go up by $20,650, aka $21,000, divided by 12, or $1,720.83 a month.
So what is that price? It ends up being what?
So then 20560 plus 413,000. At the end of 2025, the median price in the United States should be somewhere around $433,560.
So right now, at the end of this year, we're looking at $433,560 $413,000 for the average home price
In 2024.
in 2024.
Yep.
Versus an average home price prediction of 433,000.
Yes.
But the rate right now is 6.65%
Yes.
on the 413,000 versus a prediction, a conservative one of 5.75%. As a buyer or an investor, the question is this: do you want to buy the houses at this 413,000 at this interest rate, 6.65, or at a higher price? These are very conservative. Right, like these aren't extreme,
really conservative.
like super extreme. So 433,000 at 5.75. I don't know. Like right now, I actually feel like the lower house price is safer.
It totally is. So this is where your mind screws with you and math screws with you. You can refinance and change the rate. You can't change the purchase price. Once you pay for it, you can't go back to Bank of America and say, hey, just kidding, I want my 20 grand back. It just doesn't happen that way. So you always got to lock in the price today, and you can change the rate tomorrow. So always go get the good deal and then deal with the rate later. And to be honest, that's not that big of a change in rate. It's not worth waiting for.
Because the risk is this: there's a chance things could get worse and they have to lower the rates. And guess what? The home price is going to skyrocket, potentially.
If the Federal Reserve lowers the rate because the totality of the data is not in the U.S. economy's favor, and Papa Powell pulls the little lever and goes brrr with the money printer, housing is in a transaction recession, and you'll start to pop out of the transaction recession and will sell 20% more homes. If you sell 20% more homes and the rates get into the mid fives, it will unlock a lot of extra demand, and it will unlock some of that move-up buyer, which will force higher appreciation, especially in the metros like ours in the Seattle metro, where we have low supply, high demand. This will not apply to certain metros that have oversupply, like we talked about in some of the other episodes. The Zoom towns that became the boom towns, the Austin, Texas, the Boise, Idaho, the parts in South Carolina, the parts in Tennessee, and possibly parts of Phoenix, because they had such an influx of people because of COVID and the pandemic. So they're normalizing still. We're still in a lack of supply problem here in the Seattle metro. That's why in our next episode, we're going to go into these exact predictions for the Seattle metro, but we wanted to bring you the national numbers first.
The last thing I was going to say about the lack of supply, the reason that is not going to change is because it takes more than a year to fix the lack of supply problem. Like, you're not going to get developers in here unless like the government just like takes away all the red tape, all the regulations, all the permitting processes, and just, but even then it would just be so difficult. So this low supply problem that's influencing almost everything, if you think about it, more so than even rates and home prices, there's a low supply. It's like a anchor on everything else. And so with that being said, Anton, give me the TikTok summary of what your predictions are going to be for 2025 compared to where house prices and rates are in 2024.
In 2024, we finished the year at 413,000 with 4.3% appreciation in the median price across the United States, with high interest rates and a changing economy. Therefore, in 2025, you will have higher appreciation than that as the Federal Reserve continues to lower rates and as the economy still seems to be surviving everything they're throwing at it. So expect more demand, more activity, higher appreciation, and cheaper debt in 2025. Boom, plain and simple. That's the summary of everything we just talked about in 30 seconds. It's that as rates come down, demand increases. And as demand increases because of that boat anchor from the lack of supply, because we didn't even build 1.4 million freaking homes this year, so we didn't build enough again. And they're magically predicting we're going to build 1.41 next year, which isn't enough again. That lack of supply is going to keep pushing up prices as corporate America gobbles it up and pushes people out, as rich people buy their first home, their second home, and their rental and push more people out. We have to feed the middle class and the first-time home buyer. One last interesting thing, just to digress for a second. People forget how many millennials want to buy a home now, too. The millennials are now a larger cohort of spenders, bigger than the boomers, who are getting into their primary years of purchasing. They're not going to have as many kids as the boomers, so it's changing housing demographics, but we don't have enough first-time home buyers and starter homes to feed them. Like, if I was to say, what's the biggest opportunity for investors in 2025? Figure out how to build affordable product, deliver affordable rentals, do affordable land development, affordable rentals, build to rent, that whole category, ADUs, DADUs, duplexes, fourplexes, sixplexes. That is your biggest opportunity in 2025 because of the lack of permits and all the millennials coming through.
I thought you were going to say tiny homes because it's trending on TikTok. And by the way, that was a joke, and I'm kind of serious because they have to buy these smaller homes.
When you see headlines where it says, I think it was Amazon is going to sell a $40,000 starter home that's like a kit, it brings you back to the idea of Sears and Roebuck, where they used to sell those kit homes that were cheap. We have to provide affordable housing somehow. We are in a housing freaking crisis created by the Federal Reserve and our banking system that all of our subscribers already know about. You've seen us. We've talked about this. It just keeps playing itself out. The Fed and the banking system are going to keep messing with housing. And this is not going to get better. It's going to get worse. But that's also your opportunity as an investor. It's your opportunity as a buyer to create equity. But you got to get in the game and you got to play the game. Or you can wait and pay, almost $21,000 more, assuming mild appreciation, assuming debt gets just a skosh cheaper. That's all that's going to happen.